Hey there, and welcome back to Financial Market Insights for Traders. I'm your host, Sophia. And today we're going to dig deep into a topic that's shaping every market move in 2025: how inflation and Fed policy affect your portfolio. Now, this isn't just some abstract macroeconomic theory. If you're investing, trading, or even just watching your 401k, the way inflation and interest rates play out will absolutely impact your bottom line, whether you like it or not. So, if you're trying to figure out what to do with your stocks, bonds, or real assets, or if you've Googled investing during inflation 2025 more than once this year, this episode is for you. And if you're brand new to this world, don't worry. I've got you. We're going to walk through every angle of this topic in detail without the jargon. All right, let's get into it. Segment 1: Inflation, the Big Disruptor. Let's start with the basics. What exactly is inflation, and why does it mess with your investments? Inflation is when the prices of goods and services rise over time, meaning your money buys less. If inflation is running at, say, 6%, that $100 grocery bill last year might cost $106 this year. Not fun. And when inflation runs hot, like it has been throughout late 2024 and into 2025, the markets start to shift fast. So, how does inflation affect the major parts of your portfolio? Let's break it down. Segment 2: How stocks react to inflation. Stocks are the go-to for most investors, but they react differently depending on what kind of company you're holding. Winners: companies in energy, utilities, and consumer staples often win during inflation. Why? Because they have what's called pricing power. They can pass their increased costs on to customers. Think about your electricity bill or your grocery basket. Those companies aren't cutting you a discount just because fuel is more expensive. They pass it along. Industrials and infrastructure firms can also perform well. Many of them operate under long-term contracts, and they tend to be less sensitive to short-term inflation spikes. Losers. Now, on the flip side, growth stocks, especially tech, tend to take a beating. These companies rely heavily on future earnings, and inflation eats into those future profits when you discount them at higher interest rates. Plus, many of them rely on borrowing. When inflation drives rates up, borrowing gets expensive, profit margins get squeezed, and investor appetite drops. So what we're seeing in 2025 is a big rotation, from high-flying growth names into more defensive, value-oriented plays. Segment 3: Bonds, the direct hit. Now let's talk bonds. Bonds are basically IOUs. You lend money to a company or government and they pay you interest. Sounds simple, right? Well, here's the problem. Inflation eats away at that fixed return. If you're getting 3% on a bond, but inflation is at 5%, you're losing purchasing power every single year. And it gets worse. When inflation expectations rise, bond yields have to rise too, which means bond prices fall. So if you're sitting on a portfolio of long-term bonds and inflation starts rising, you're going to see some red in your account. So what's the move? Look into TIPS. That's Treasury Inflation Protected Securities. These bonds adjust for inflation, so they're designed to protect your real return. Floating rate bonds are another tool. They adjust their interest payments as rates rise, which helps protect against inflation-driven losses. Also, short-duration bonds are less sensitive to rate changes, so they're safer in this kind of environment. That's what a lot of smart money is doing in 2025, getting shorter on duration and more tactical on yield. Segment 4: Real assets, your inflation shield. Next up, real assets. And these might just be your best friends when inflation shows up. We're talking about real estate, commodities, and precious metals. Let's start with real estate. Real estate. Rental properties can adjust prices pretty quickly. Landlords can raise rents, especially in tight markets, to keep up with inflation. That makes real estate a natural inflation hedge. Publicly traded REITs, real estate investment trusts, can also benefit, particularly those focused on residential, industrial, or logistics sectors. Commodities. Then there's commodities. Oil, copper, wheat, you name it. These are physical goods with real-world demand, and they tend to rise in price right along with inflation. That's why you'll often see commodity ETFs or futures show up in inflation-resistant portfolios. Precious metals, and of course gold. the traditional inflation hedge. Though, let's be real, gold isn't always reliable in the short term. It reacts to a bunch of things: interest rates, the dollar, geopolitical risk. But over time, it's still a core inflation hedge in many portfolios. Silver and platinum have a similar dynamic, especially when industrial demand is strong. Bottom line, in 2025, more investors are moving a portion of their portfolio into these tangible, hard asset plays to hedge against currency debasement. Segment 5: Fed rate hikes, the domino effect. Now let's pivot. Because when inflation gets hot, who steps in? The Federal Reserve. The Fed's main tool to fight inflation is to raise interest rates, which they've been doing in 2025 aggressively. So, what happens when rates go up? Borrowing costs rise, economic activity slows, demand drops, inflation hopefully cools off. But while the Fed is trying to engineer a soft landing, these rate hikes can shake up the markets hard. Segment 6: Fed rate hike impact stock market. Let's talk about Fed rate hike impact on the stock market, because this is where things get real for traders. Here's what happens: companies pay more to borrow. That means less expansion, less hiring, and sometimes layoffs. Consumer spending drops. Higher mortgage rates, higher credit card APRs. People start tightening their belts. Valuations reset. Those same growth stocks we mentioned earlier, their future cash flows get discounted at a higher rate, which lowers their value in the present. In other words, when the Fed raises rates, risk appetite drops. People sell speculative assets and move into safer territory. We've seen it play out across multiple sectors in 2025. Tech and crypto-adjacent stocks are pulling back, while defensive sectors and dividend-paying stocks are gaining traction. Segment 7: What about bonds? Bond yields move in anticipation of Fed decisions. So when a rate hike is expected, bond prices drop in advance. This has led to yield curve inversions at several points in 2025, where short-term yields exceed long-term ones. And historically, that's been a recession signal. Still, some bonds look more attractive in this environment. Short-term treasuries offer solid yields with minimal risk. Investment-grade corporates are paying out well for moderate risk. Munis, or municipal bonds, also provide tax advantages and inflation resistance for higher income investors. So if you're in bonds, the key is to be selective and nimble. Segment 8: Smart inflation hedge strategies in 2025. All right, let's talk strategy. If you're investing during inflation in 2025, you need a plan. Here are 4 practical moves. 1. Rotate into resilient sectors. Think energy, healthcare, and consumer staples. These sectors hold up well when inflation rises. 2. Diversify globally. Emerging markets and commodity-driven economies often benefit when the US dollar weakens. Global diversification spreads risk. 3. Increase exposure to hard assets. That includes real estate, commodities, and precious metals, things that hold intrinsic value over time. 4. Add alternative assets. Private credit, hedge funds, and infrastructure plays can offer returns that aren't tied to stock or bond markets. The idea is to reduce sensitivity to inflation and interest rate shocks while building in real growth. Segment 9: Tools to help you adapt. All of this sounds like a lot, and it is, but you don't have to do it alone. Start with a smarter trading platform. The Crystal Ball Markets trading app is built for this kind of environment. It's world-class, cutting-edge, and user-friendly, perfect whether you're a day trader or a long-term investor. You can chart inflation trends, backtest strategies, and trade globally, all in one place. Check it out now at crystalballmarkets.com/platform. Headphone, and if you're still learning, the Crystal Ball Markets podcast is your new best friend. It's beginner-friendly, practical, and all about breaking down macro and financial markets in a way that makes sense. You'll get real insights, no fluff. Subscribe now at our ss.com/podcast/crystalballmarkets. All right, that's it for today's episode of Financial Market Insights for Traders. We covered a lot: how inflation hits stocks, bonds, and real assets, how Fed policy reshuffles the board, and what smart investors are doing to stay ahead in 2025. If this episode helped you, share it with a friend, subscribe for more, and remember, Don't just react, adapt. I'm Sophia, and I'll catch you next time.